We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Heath Binder of LBX Investments. Now, Heath is taking a little bit of a different look at the real estate syndication and real estate investment world because he is involved in open air retail, open air shopping malls, open air retail type investments. And the reason why I wanted Heath on here to explain some of this to us is because typically we have been known to be mostly multifamily, some self-storage type stuff, but this is a different animal. This is a completely different animal that has the potential for massive profits with a weighted risk element. Now, what can you tell us, Heath? How are you today?
Good. How you doing?
Awesome, man. Doing great. Just glad to be here and glad to be here to talk about retail investing. And hopefully we can bring the listeners some value in learning a little bit more about it. So I like to start, just tell me a little bit about yourself, how you got started and what years maybe some different elements happened to that. And then we'll kind of go forward from there.
Sure. I mean, so I'm with a firm called LBX Investments. I run investor relations.
Okay.
Been with LBX since the outset, and been in the real estate industry since 2001. But I come from a family where my mom is in real estate, my uncle is in real estate, so it was always around me. But after college, I moved to New York and I took a job at Collier's. Been in the industry a long time. I actually in I guess it was 2014. I took a job at a crowdfunding platform back in the early days of that industry. So that was
What year was that? I'm sorry.
That was 2014.
Okay. So yeah.
Yeah. So that was back in the days when it was a novelty. Now it's become a lot more commonplace.
Yeah.
But that's kind of why I'm in the seat I'm in today. I started off running investor relations at one of the crowdfunding platforms, and then ultimately moved over to the buy side.
In 2014, that stuff had a huge learning curve ahead of it, didn't it?
Yeah, it was a really interesting time because the Jobs Act had just been passed, and just it triggered a lot of entrepreneurial activity in that space.
Yeah.
And so I've been working with investors a long time, and in terms of this company, it's interesting, right? Retail is a contrarian space. There's a narrative out there because I always joke with people, we're the only sector that has its own apocalypse, and there's been some high profile bankruptcies, Toys R Us and Sears, kind of companies been around a real long time that have.
Circuit City was the big one I remember.
Yeah, Circuit City, right? And
Yep.
And so people, and then you see in the headlines, there's just, people talk about Amazon and its relentless growth, and it all kind of combines to create this narrative that a lot of people think that retail is dying, that we're all going to be transported and we're all going to be getting carted around in self-driving vehicles, and
Yep.
we'll never leave our house, right? And the reality is, like anything, there's some risks in retail, but there's the baby sort of got thrown out with the bathwater in the sector, and we've been finding really interesting opportunities for the past several years, and we've had a lot of success with our strategy. There are areas of retail that we focus on. There are areas that we stay away from, but broadly speaking, it's been a really good sector for us, and happy to tell you more about it and kind of go whatever direction
Sure.
you'd like.
Sure. And so I guess some of the initial questions that we have now, there's been a slight bit of retail development in say the last 5 years because basically from like oh I mean I don't know what oh 02, oh 03, oh 04 through like I would even say 17 and 18 like retail development part of it was just like non-existent. I mean, other than there was obviously a few projects taken off, but it was just like I said, everybody. When you start talking about retail and retail investing, it's like it seems to me like your biggest objection, at least from my standpoint, if you called me as an investor relations and said, "Hey, man, I got this wonderful deal over here. It's got an anchor store and it's got 5 other tenants, and this is what we're doing," and I'd be like, "Okay, how Amazon resistant are those tenants?" At least that's my initial like jump to, and I'm sure that you have an answer to that objection. But in a post Amazon is here world, um, what are the common objections you have to people that look to invest in the retail space?
Um, well, so first off, when we talk about retail, I always try to segment it for folks because if you're
Mm-hmm.
just looking at the space and you just think, one
Yeah,
piece of
it's easy to
retail,
lay a blanket over the whole thing. I mean, I understand.
yeah. So what we focus on are we don't buy enclosed malls, and
Yep,
that's where I think the largest concentration of problems has been.
yep,
And I mean, look, there are certain, I guess, cliches or adages that we all know in the real estate business. One of the most famous is location, location, location. What we
yep,
always look to do is to buy a really good piece of real estate. It's really our
yep,
starting point. And what you find is there's good deals in retail, there's bad deals in retail, there's good deals in multifamily, there's bad deals in multifamily. I mean, it's we try to do is we try to buy the good deals in retail, and these are centers where they're centrally located. I mean, we've all seen it. I mean, if you go to the local supermarket or TJ Maxx or you can kind of go down the list of tenants that are really thriving. You'll see these. If you go to the best center in town, it's typically very busy. Doesn't matter what
yep,
time of week it is,
yep,
right? And um, so we just look to buy very well located assets that have good ingress, egress, visibility. That'll have strong tenants, assets that we think that in good times and bad are going to continue to attract demand from shoppers and retailers. That's I mean, I wouldn't call it secret sauce, but that's just kind of how we think about the acquisitions that we make.
sure,
And as far as your question about objections, certainly I get people telling me, oh, I'm afraid of this tenant, I'm afraid of that tenant. I had somebody tell me, for instance, we're looking at a deal right now. We're buying a deal right now. It's got a Hobby Lobby, and I had a tenant tell me, "Oh, I don't like Hobby Lobby. There's nothing that Hobby Lobby does that."
a tenant or investor? You had an investor tell you that?
Yeah, an investor. I showed him the deal, and he said, there's nothing that Hobby Lobby does that can't be replaced by Amazon. And I said, well, you know, that's not true. And I showed him a whole big write up that we have on Hobby Lobby because we do a lot of financial analysis around the tenants at our centers. The
Sure.
company's been around for decades. They're growing. They're opening stores. They have no or hardly any debt on their balance sheet. They do
That's the biggie. I think the biggest part about Hobby Lobby is the debt that they don't bring to the deal.
nothing. They're run super well. They do like 6 billion a year in sales, and I because of my seat, right? I work with people all over the place, and I told them, I said, look, like you don't also understand. I don't think you understand that the the you know what is popular in a major urban market, might be different from what's popular in the middle of the country, and
Yep.
um,
Well, and here's the thing. It just occurred to me when you talk about Hobby Lobby. To me,
When my wife wants something, she doesn't want to order it. She wants to go get it.
Yeah, exactly.
Or crafts for the kids for school. The kids got to have crafts. Well, you and I both know, and I'm sure every listener that hears this knows that none of that crap gets done until the day before. Well, the day before you can't order it, so you have to go out there and get the foam balls and the foam cylinders and the paints and all that stuff. So I think there's a certain element of that is going to come back to real life living. Like this is the reality. In an ideal situation, yes, you order it off Amazon, you save a third of your money, and you go on. But there again, I don't know that I've ever done a school project with any of my kids, and we've got five of them. Any further before than the day before.
Yeah, it's funny. I told a friend of mine about the guy's comment, and she said, he just doesn't understand suburban housewives. That's what she told me. And,
Spot on, man.
and I,
Spot on.
and I said, look, like, I don't go in craft stores. It's not my thing. My wife loves to take our kids, and they spend a lot of money, man. I mean, it's crazy the amount of money people spend when they go to these stores.
Hey, and I don't know that my wife's ever bought anything at Hobby Lobby that wasn't on sale. I wonder if that's planned. It's all always on sale, and I tell her, I'm like, honey, they can tell you it was whatever price they want to tell you. It's on sale doesn't mean it's a good deal.
Yeah,
But
well, if you buy 10 of them,
that's right.
you're getting a discount. But so a couple things, right? So one is, there are a lot of retailers like that have a lot of strength
Yep.
and financial strength. They're expanding, they're opening stores. I mean, go down a list of them. There's companies like Ross and TJ Maxx and Ulta is another one. I mean, these are companies that have fantastic financials. The pure fundamentals are great. What you look at. One of the things you look at is when they sign a lease.
Yep.
You want to make sure they're going to be there a long time, and there are a lot of these companies that they have staying power, right?
Yep.
The other thing maybe to point out is, I think people like to categorize things,
Yep.
and so it's easy to say, well, Amazon, is the online category, and then the offline category is the bricks and mortar guys. In reality, what you've really seen, develop over the last several years. Hold on, I'm gonna close this door. What you've really seen develop over the last several years is the largest, most sophisticated retailers. Not all of them, but most of them have really figured out ways to. They put a lot of money into their online platforms, and they figured out ways to integrate their various platforms so that you as a
Sure.
shopper can get what you want when you want it. And
Yep.
I think you had mentioned we were chatting earlier, and you had said something about Circuit City going out was the something that you had remembered. What's interesting to look at is in that same space, look at a company like Best Buy,
Yep.
which they are neck and neck with Amazon
Yep.
in the electronics section. And if you ever go and they were close to going out not too long ago, 10 years ago,
Yep.
they were really, I mean, I don't know when Circuit City went out, but it was around that time. And, Best Buy was certainly viewed as a risk. And what they did is they completely reshaped their business strategy. They invested heavily into their people. They invested heavily into their stores. They completely reconfigured their stores. If you remember going into Best Buy years ago, and it was like there was just like CDs and DVDs, and like that was the experience.
Yep.
Now,
Yep.
if you go in, there's like a little corner section maybe that'll have some titles. But what they've done is they've carved out all these different zones for all these different third party retailers to sell products, and they've invested heavily in the stuff you don't see, right? The back end supply chain investments they've made
Right.
mean that now if you want something, they can get it for you really quickly. They've
Yep.
invested in price matching. I mean, there's a whole list of things that they've done, and now
Well, and they've
they're
integrated.
great.
They've kind of taken what Amazon does and they've overlapped those two, because you can basically have an internet purchasing experience with a going to the store experience all in one
Correct.
kind of place. So, what constitutes, um, there's a big question that I've got. I'm sure it's not going to be a short answer, but maybe make it as short as you possibly can. But
Sure.
what constitutes an anchor store? Like, first of all, an anchor store is obviously at the end, but are there certain, like, what kind of criteria? What what constitutes an anchor store?
Sure. And I think what we can do is I can kind of explain to you what an anchor is and how it kind of fits, at a center that we'll buy,
Okay.
and then talk about some of the different ways that will generate upside, right?
Okay.
Because it's all tied to that in a sense. Um, so an anchor is going to be a national retailer a lot of the time. It's going to be somebody like a supermarket. They're going to have a bigger footprint, right? So it'll be a
Okay.
supermarket or a Hobby Lobby or maybe a Target. It's basically there's a trade off. They either own their own real estate or they pay a lot less on a per square foot basis than the other tenants at the center.
Okay.
In exchange for that, they're bringing a lot of the traffic, right?
Yep.
So if you have a really good, save a Kroger, like a really good supermarket, and maybe they're paying you know half on a per square foot basis, but it's on a larger box. And what they do is like they'll have some rights over kind of what you can and can't do in your center,
Hmm.
but they are the main attraction, right? That's how to kind of
Okay.
think of an anchor. Now, what we do a lot of the time is we'll buy centers with um, we'll buy grocery anchored centers and we'll buy non-grocery anchored centers, but we will buy centers a lot of times from big institutions
Okay.
that will have anchors in place. What one of there are two kind of key ways from a numbers standpoint that we generate upside on our deals. One is we'll focus on the smaller shops, on the leasing of the smaller shops.
Okay.
Because if I buy something from let's say I buy something from a REIT, it might have the anchors in place, but then some of those small shops, like a nail salon or a martial arts place or a restaurant, you know, that guy who's coming in and taking 3,000 square feet and paying $25 a foot instead of, or $30 a foot instead of the 10 or 15 that the anchor's paying.
Yeah.
You do one of those leases, it doesn't move the needle that much. But if you do like three or
Yeah.
four of them, it starts to really
Yeah.
move the needle on your metrics.
Yeah.
So we'll focus a lot on the shop leasing when we buy a center. It's an area that we've really been able to generate upside across our portfolio. The second is out by the street. You will have sometimes you call them pads. You'll see we call them out parcels, but you'll see like a McDonald's or just I don't know, a Chick-fil-A, somebody that's some restaurant chain or maybe like a Jiffy Lube. They'll it's basically they take space out by the street,
Yeah.
and that's the stuff you see when you drive by because it's closest out to the street. Those out parcels tend to trade separately, right, in their own market. They trade to 1031 investors and institutional buyers. So that market operates differently than the multi-tenant retail. So we'll
Sure.
buy a center that'll have an anchor. It'll have a lineup of shop spaces next to it, and then out by the street it'll have some out parcels. And we can generally, let's say we buy a center at a 7 or an 8 cap. We
Okay.
can a lot of times sell those out parcels at lower cap rates. So by doing that, you're basically because you bought that as part of the center. So let's say you buy a center at a 7.5 cap, and then you sell the out parcel at 6.5 cap. You're
Yep.
playing that arbitrage, and it's a nice outcome for
Sure.
investors. And if you have a
Sure.
center that has a few of them, it really does add up and move the needle.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
Well, and that's again, like, so the first thing that my mind goes to is like, and again, this may be a little bit of small town thinking, if you will, but a lot of times we're not necessarily looking for mom and pop kind of places. You're looking for like pet stores that might be nationwide pet stores, or makeup stores, or I'm just trying to, and I guess something that may fall between an anchor and a small spot would be like an Apple store or something along those lines. Um, but it's interesting to me how the formula, and you start looking at the return, and then how some of those big box stores can like, they're almost like the Facebook ad, I guess, if you will, where they're pulling the attention. Somebody's there buying whatever, and they're like, oh shoot, I needed to go get a lizard, so they go down to the pet store and they buy a lizard. But around like some of the small towns, it's just hard to imagine the big retailers, or even medium retailers going in there to a Kroger anchored store or something like that. So it's
Um,
just,
we so we don't go to super small markets typically. We will go tertiary. We have, so I mean, it's one of maybe the best performing center in our whole portfolio is in South Augusta, which is it's not it's not a it's not Atlanta. We own in some bigger places. We own outside of Nashville. Um, we own outside of Charleston.
yeah,
Um, we will go tertiary. We don't go super super small though. Typically, that's
sure,
we want to make sure. Kind of going back to my comment from before, we want to make sure that whatever site we own is going to be in a good position to attract demand.
yep,
So now, as far as the type of demand, we will definitely work with local retailers. Actually, our model, um, one of the I'd say differentiators for us is we're vertically integrated. So our head
okay,
of leasing sits in Charlotte, but almost like a GC would work with subcontractors for deals that are outside his drive time. Like we buy a deal in Chicago, or we buy a deal in Indiana, or just anywhere that's more than a few hours away from him. We'll
yep,
work with a local leasing team because it's really important to be able to lock, to knock on doors and get get that local guy to come in and lease space. Yeah.
sure, yeah. And it's so, I don't know, like I said, the retail space, and like I told you prior to the show, the retail space is just out of my wheelhouse as far as my knowledge. And
Yeah.
but are the cap rates compressing in the retail space much like they have in multifamily, and or are they still like 6, 7, 8?
Yeah, they definitely not like multi. I mean, one of the most interesting aspects of retail, of open air shopping centers, and particularly in the current climate, is that even though there's been some cap rate compression, you're still buying deals at cap rates that are well north of where you're seeing multi cap rates.
Sure,
So we're buying a couple deals right now. The cap rates are starting with a 7, right? Which actually a little higher than that.
starting with
One's I think a
seven.
7.3 and one's a 7.5, and this is both these both of these centers have a really strong lineup of national tenants.
Yeah,
Um, so and to that, right, one of the nice aspects of our deals, and everything we do is deal by deal. We don't have a fund that we're offering at this point. But every deal that we've done, it's had positive leverage going in, right? And
yeah,
all that
yeah,
means is the cost of our financing is cheaper than you're going in cap rate. And then
yeah,
going back to what I was saying about out parcels, what you can do is you can sell off pieces of a center a lot of the time, and that 7.5 cap that you buy something for, as you sell off
yeah.
out parcels, turns into an 8 cap and 8.5 cap, and then your debt's not changing, right? But you end up owning a
Right.
center where you might have 450 basis points spread between your cost of debt and your cap rate that you end up owning it at. So
Well, and you're also, I guess, at the same time, you're also gathering an audience that might be an intermediary audience between your anchor store and your pet store, by, like you said, having a Jiffy Lube or McDonald's, or even it could be beneficial to the anchor store because then people come there, then they can grab something to eat on the way out. I mean, I guess that's probably the patterns and stuff that I look at is what do people want once they get where they're going, and that's what we look at in multifamily. Once people say, "Hey, yes, I'll live there," what do they want to increase the quality of their life? And again, it seems like some of that stuff when it goes together, and it could be tough to calculate. I guess put a calculatable number on this, but at the same time, I guess that just seems like an added benefit to me anyway. Not only are you increasing your revenue, but you're also and increasing your cap rate, but you're also potentially increasing the traffic, which is going to make the spot more valuable overall, right?
Well, it's interesting because what you're talking about, and it's it's a sophisticated way of thinking about things. You're talking about merchandising, right? You're talking about you have a center. You know, how do you lease up any vacancies in such a way that you don't junk up the look and feel of the center, right?
Yeah, that's right.
Because for some centers, certain tenants might be really appropriate, but they might not be appropriate for the other center, right? For instance, we own a center in, do you know Memphis at all?
A little bit, yep.
All right. So we own we bought last year, we bought a, really, really nice center in Germantown, which is pretty affluent submarket.
Germantown is very nice. Yes,
Yeah,
I've been there.
it's super nice. And so we bought it's a great piece of real estate. It sits right in the center of everything. It's got a Best Buy and REI. And when we bought it, there was a vacant Staples. Well, they hadn't gone dark. They'd gone dark, but they hadn't left yet. There was a Staples that they'd been paying rent, but the rent was due to. This is a known vacancy that was coming up. They basically were not going to renew, and we were going to have 18,000 square feet to lease. And so we've given ourselves a few years to lease it, and we're in talks with some different groups, but there were some national chains that we potentially could have just come in and put them in there. But it wouldn't have fit with the merchandising and with the clientele that actually goes to the center. And to your point, you have to be really, really careful and thoughtful about how you lease up a center, because you want to make sure that continues to always be attractive to the people who live around it.
Yeah, you want to make sure that it somewhat goes together too. I mean, in a way,
Yeah.
and again, I guess you wouldn't want to put a Staples at one end and an Office Max at the other.
Well, there's restrictions. So a lot of times what'll happen is, a tenant will, particularly for a national tenant, they've all got legal departments. So what they'll do is they'll sign a lease with you, but then as a stipulation within that lease, they're going to say, well, you can't have one of our competitors, you can't have a direct competitor in the same center. So one of the interesting aspects of retail that maybe you don't see as much in other sectors is when you get into the leases, there are a lot of these sorts of restrictions and just kind of risks to think through. We're very, very thorough when we're analyzing our deals because we want to make sure we understand what all those restrictions and relationships are. But it's definitely something that comes up on a lot of deals.
Now, when you're looking at, so obviously somebody can't just walk up to you and say, "Hey, Heath, I want to lease this 18,000 square foot building because we're going to become car mechanics." And so, what types of, so obviously financial strength and some other stuff comes into play. What types of things do you all look for in new tenants that have the potential to be a big draw? Like, obviously, the nationwide companies, you can go through their financials because they're probably public due to their stock being traded on a public platform. But what else do you all look for when you're picking through some of these things to make sure that you've got somebody that, for lack of a better term, are Amazon resistant, I guess?
So I guess a couple things. See, you always look at the use. right? And that sort of goes to the first part of your question. You look at, what they'll be using the store for. You want to make sure that anything that they're going to do at the center isn't going to run afoul of um, what's been agreed to in other leases. There's a document that kind of that governs the relationship between all tenants at a center. It's called the reciprocal easement agreement, or an REA for short. You
Okay.
just Any tenant that comes in, you just got to make sure that everybody's playing nice in the sandbox together. Because if they're going to come in and sign a 10-year lease, um, then everybody's going to be at the center for a while. So you got to make sure that
Yeah.
everybody's getting along.
Sure.
As far as Amazon resistance, we do a lot of credit analysis for sure. To your comment about these being public companies, a lot of them are. So and even if they're not public, if they're private, there's a lot of information out there about them. So we'll certainly look at things like their business model and how it fits and kind of what they're doing from a corporate standpoint. Um, Case in point, box size is pretty important. Like if a Burlington came to us, well, I mean, this is kind of a silly example, but if we saw a center and it had, like a Burlington or somebody like that in an 80,000 square foot box, we
Yeah.
would probably struggle to get comfortable with it, because the trend that you've seen over the last several years is that they've been moving into, smaller footprints, like 35, 45,000
So
boxes or square
even
foot.
outside of just straight financials, you could potentially be looking at their past, what they, how their business model has changed in the past,
Oh
say,
yeah.
5 years.
Yeah.
So
Yeah. We'll look at that. We'll look at, what they're, because there's two things you're thinking about, right? You either have a vacancy that you need to lease up, or you have a tenant that's in place when you're buying.
sure.
So what you need to do is understand, you want to understand how they're doing at the center if they're there. You want to
Yep.
understand, broader corporate trends. Certainly their, credit analysis goes into that. You want to understand what the market rents are for that box. Case
Yep.
in point, we'll underwrite deals where, maybe we have a tenant that's, in there at, $15 a foot. But if we think that the market rent for their space, if we think they struck a deal that is, too expensive, then we have to be really cautious about how we underwrite, what an extension might look like, because, they may opt to, come back to us and try to negotiate for, something different.
Sure.
Um,
You could probably average, take the how many years they have left at that square footage price, and then go that many years out, and then double it and try to get an average of where it might be, I guess, right?
it just
To kind of
it really depends on kind of who they are and how they're doing at the center. We'll look
sure.
at pretty interesting innovation that you've seen is there's location data now, so we can look at
Yep.
cell phone traffic to see, like I can look at a tenant and a retailer, and maybe they have 50 locations in a state, and I can look at how a specific location stacks up versus the other 50.
Yeah. Yeah.
Right. So there's all
Kind of.
all sorts of data points. But one of the things that you look at too, kind of going to your question about Amazon, some retailers, they don't really need to have an online presence in order to thrive. So some of the best examples of this are maybe the dollar stores, or some of the off price guys, like Burlington or Ross or TJ. Like the idea of, like, if you go to a Ross, for instance, or a TJ, I mean, I think TJ is the one that always talks about the treasure hunt experience.
Yep.
People like to go and shop and like see what they're going to find in store. So it
Yep.
doesn't lend itself as much to, to really strong online capabilities.
Yep.
Um, but something
The
else,
data's hard when you go for a pair of jeans and you end up with a water bottle.
yeah,
I mean,
it's kind of,
that data is very, very difficult. You end up with a water bottle that TJ only had, that they ended up with 5 of them across 100 stores, and you
dude.
just happen to be one
My,
that
my
found it.
mom will go into TJ. She'll come back. She'll have like 50 plates. She'll have 10 pairs of. I mean, it's
Yep.
and she'll
I'm
look
a
at all
victim
the.
of TJ. I'm a regular victim of TJ
Yeah,
Maxx for
yeah.
sure.
It's
Kids, wife, ex-wife, they all go to TJ, and everybody buys and buys and buys.
yeah,
And anyway,
Yeah,
Uh,
it's a great business model. But one of the things you want
it
to
is.
look at with respect to Amazon, so I think a lot of times people think, okay, well, people are shopping more on the internet, so it's damaging bricks and mortar. The guys who have struggled the most in bricks and mortar, they a lot of them have been mall tenants. Um, a lot of them have been over leveraged, right? You've seen companies get bought out by private equity shops and you put too much debt on their books. And one of the interesting aspects of retail is it's a space that you got to innovate or die, right? It's always
That's right.
changing. And so
Yep.
the retailers that have struggled the most with leverage, they're taking any free cash flow they've got and they're paying down debt. They're not investing in new technologies and new strategies and just investing in their business. And you've seen, I mean, there's a lot of retailers that that's been, I'd say, the biggest contributor to their demise. Not
Yep.
because it's kind of funny. Like if you think about, look at like a Target versus kind of an old fat like maybe a Sears. I don't know, but look at what Target does versus what maybe an old fashioned department store does
Yeah.
that has gone out of business. It's not like what they're selling is miles different, right?
Yeah.
But then you look at how much more sophisticated Target is,
Yeah.
and how they've
Really.
integrated their online and offline platforms and how they've introduced like white labels and just I'm
Well, and again,
oversimplifying.
it kind of started taking the offline and online experience and kind of smashing them together and saying, "Hey guys, this is the new normal." And Target did a really fabulous job. I mean,
Yeah,
Target's done a fabulous job at a lot of
fabulous.
different.
Yeah, we have a bunch of Target shadow anchored centers. We
Yeah.
we love buying them.
Yep.
And
Well, listen,
yeah,
we are getting near out of time
okay,
for this episode, and I've got a couple of questions. There's not a right answer. There's not a wrong answer. As the listeners know, there is definitely at times some interesting answers. So,
yeah.
what is the best book that you've recently read or are currently reading?
It is called. I have to tell you what the exact title is. I'm reading a book about. Um, hold on. I'm reading a book about the St. Louis Cardinals.
Yeah,
I just started it. Uh,
that's my team too, by the way.
oh, is that right?
Yes.
Yeah. So it's. I think it's called Ricky and the Redbirds. Hold on. I'll pull it up and I'll tell you. I think it's called Ricky and the Redbirds. It's basically it's about the history of the St. Louis Cardinals and then about Branch Rickey, who everybody associates with Dodgers because breaking the color barrier, et cetera. But he also was key figure in developing all the infrastructure that made the Cardinals as great as they are today. So anyway, I just started reading that a couple weeks ago. It's pretty interesting.
Awesome. There's a book called A Bitter Brew that
A bitter brew.
Bitter Brew, and it's actually about the Cardinals and the Bush family and um, their how they kind of I'm gonna say crossed one another because they won. I think the Cardinals were owned by the Bush family for a while,
Yeah,
but it goes into how the beer industry then ended up acquiring the baseball. It was pretty neat. So
interesting.
that might be one you check out too. So, all right. So, what is the best trip that you have? What is a dream vacation that you've taken or hope to take in the near future?
We went to Iceland a couple years ago in the winter, which
Oh,
is
Slinky. What's that? What's the or Oslo or where'd you go?
no, we went to Reykjavik and then just you drive around and you feel like you're on Mars or something. I mean, it's a different world.
Really?
Yeah, it's unlike anywhere you've ever seen. I mean, although then I got friends from Alaska who tell me I can just go up to Alaska and it's just as striking, not as far. But
Yep.
yeah, Iceland was pretty remarkable.
That's awesome, man. That's great. I think that's probably one of our favorite questions that the listeners like to hear where people have been, and because all of us have those trips that we'd like to take and see the world. So, all right. So, if the listeners heard something that resonated with them and they'd like to reach out to you, what is the best way for them to get a hold of you?
Sure. So lbxinvestments.com is our website.
Okay.
And people can always email me at heath@lbxinvestments.com. So HEATH at lbxinvestments.com.
And that's LB as in boy, X investments.
Yeah.
As my listeners know, I'm always big on making sure that we get the plurals correct.
Correct.
So lbxinvestments.com.
That's right.
Heath, thank you so much for being with us today. We appreciate everything you've given us, and we hope the listeners have found some value. And maybe, like I said, if you're interested in investing in retail, or if retail wants to become a part of your diversification strategy, give Heath a call or shoot him an email and give him a chance, because we've done our best to make this discussion as lively as possible. At times, retail stuff is more about the numbers instead of the lifestyle, like we talk about so many times in multifamily, and that, when you start talking about lifestyle things like adding arcades and adding weight rooms and doing stuff like that people really get to talking about or get energetic about, and then you come in and you're like, yeah, we added another basis point to this by doing that. That's the kind of stuff that so we've done our best to make retail discussion interesting. But again, if you're looking for that diversification part of your portfolio, shoot Heath an email and let him know, and get to working with him, because I can guarantee you that LBX will give you what you're looking for as far as that goes. So Heath, thank you again.
Yeah, thanks so much. Thanks, Keith.
Absolutely.
Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.